January 19th, after the market is closed, I'm going to talk about the short-term market action, what's been happening the last week or two, what we expect for the near term. But also, I've been promising that I would discuss the yearly forecast, the big picture, and what to expect in 2023, okay? All right, so let's start with what's been happening. First of all, the market came down the 17th through the 19th, but we expected it to come down more, and we expected it to come down sooner. So why this is happening is very simple. This market wants to go up. It wants to go higher, okay? The short-term cycles are going to be squeezed, and the declines are going to be less than expected. The rallies are going to be more than expected. That is not to say that we will not have some correction, and we're expecting the correction to continue, the one that started this week, to continue until the end of the month, until February 3rd as an initial low point. And in terms of price, we're looking for the 38.50, 37.80 to 38.50 as a target area by that point of February 3rd, okay? Now, going forward, this market is basically in an uptrend that started in October. If you look at it carefully, it seems to have 5 waves up off the October low. And we're in some sort of a 2-wave correction or a corrective ABC format. And I think this ABC correction is not going to end in February, even if it does go down to the 3,800 area. That's just the A of the 3-wave correction, which will go on until May. So we had a rally from October until January, and ultimately a 3-wave correction, an ABC correction, until late April, early May. Now, the internal structure of that correction is likely that what we're dealing with here is fairly minor. This decline until February 3rd is probably fairly minor. There's another rally phase that's likely to take place until late February, between the 24th of February and possibly another high around March 3rd. And then it should go down to the late part of March until like the 24th or 26th of March, and then have a rally up until early April. And that rally up until early April will be part of the B of the B. So this is an A, and then we have a B wave, which starts February 3rd and goes up until probably around April 1st. And then the C wave, which will be the most dramatic decline phase, starts April 1st and goes down into late April or early May. Now, it's also possible that the high that comes in late February, early March, has a nice decline phase that ends in late March. So there's one possible decline from February 24th to March 25th or 6th, and there's another decline probably from around April 1st to April 26th, 28th, and those two are likely to be the more severe declines that we have, okay? Now, this is going to take a little longer than my usual video because I want to go into a number of examples of what the long-term picture is likely to be and why, and it may take some time to go through the different charts. But it's important for you to realize that both the 20-year cycle and the 30-year cycle, it's actually 29.5-year cycle, both of them are bottoming in the next few months. The 20-year cycle has a habit of being 20 years and 2 months, and it's bottomed out in 1922. It came in April of 1942, came in June of 1962, came in August of 1982, and it came in October 10th of 2002. Notice each one is 20 years and 2 months after, and they're very accurate, you know. The next one would have been December 10th of 2022, and it's possible that that low is going to be taken out yet. Now, if you look at the 20-year and 2-month cycle, it actually had a rally up into January, February, and then another decline into March, which could, in this case, be 20 years and 2 months later. that could be a high in March and a low in May this time, early May. Okay, so until early May, it's possible that the market will be in a corrective structure. I don't expect a dramatic rally, but I do expect it's going to take out the downtrend line on the S&P. Note the Dow has already taken out its downtrend line some time ago. Okay, so that's not a big surprise. And it's possible that by May we will retest the lower point than we reach in early February or in late March. Okay, I'll show some examples of patterns that it could be resembling, which are related to the present market, and our trade forecast technology has helped me dramatically to locate these patterns and to figure out which cycles are actually real and which ones aren't. And also the Ichimoku Cloud technique has been particularly helpful in terms of allowing me to see when the trends are starting to be confirmed and when indeed we can see a potential trade to go long.
For example, the gold market, we recently saw via the Ichimoku that it had broken above the Ichimoku and it gave us a buy signal. And in this other one, the second chart, the yen broke above it. We haven't yet got a buy signal, but it shows there's a possibility of a trend change that's coming for real. This third chart is the S&P, and the S&P still hasn't broken above the Ichimoku Cloud, and therefore it hasn't generated even the hint of a trend change. However, this information is very reliable, and it's something that I think would help any trader to get a handle on when the markets are really likely to move in another direction. The cloud that we're using, by the way, is our version of the cloud indicator with modified and improved inputs. And this one will actually work significantly better than, in our experience, than the traditional inputs that you get on your computer. Oh, and you can access the information about these settings and also the entry and exit techniques that we use in our cloud system in a course format, and the information for that is below. So going back to our yearly forecast.
Very important that it's understandable that the 20-year cycle is real. And it's also true that there is a 30-year cycle in the markets. And there were two particular occurrences. One was in 1993, and the other one was 29.5 times 3, or 88 years ago, 1934. Both of them are in line with this cycle. They both are examples of this cycle. And both of them look extremely like each other, which is important. And they also look very much like the present market. And I'm going to show you an example of how 1934 Dow Jones Industrial Average chart and the 2022 DJIA chart have incredible similarity. And what's interesting is 88 years ago, there's nobody who was trading 88 years ago who's still trading today. You'd have to be at least 100 years old, and I don't think any 100-year-old traders are out there at the moment. So take a look at the chart here. This is very significant that on the upper part of the chart we see the present market, and on the lower part of the chart we see the 1934 market. And what you'll see there is that the number of days backwards from where we are, I'm calling the 0 point where we are right now, and if you count backwards the number of days, trading days, you'll see that there was a high point 29 days earlier in our present market. There was a high point 29 days earlier in the 1934 market. There was a low point 63 days later in that market, and about 58 to 60 days later here. There was a high 103 days earlier than our present point in that market, and 104 days earlier in our present market. There was the prior low was 144 days earlier from here, and again 144 days from this point in early 1935. It matches. So I mean, how could that happen? You know, that you have such similar patterns with completely different people trading with huge amount more volume, with tremendously new techniques, with multiple countries being able to trade the American markets at the same time. It's a remarkable fact. And this is why the knowledge is useful. This is why this knowledge of what causes these cycles and where to locate these cycles is extremely helpful for any trader who's interested in understanding what's really happening, okay? So that's just one example. And if you look forward, it may not be identical to what happens going forward, but it's going to be probably pretty close because it's been pretty close for the last year, okay? And where we are right now is in that market, in 1934 market, it went down for a couple of days into ultimately February 3rd. I labeled February 6th, but the low came in a few days earlier. And then a February 20th high, and we're looking for a February 24th high based upon the short-term work that we're doing. Then it called for a March 22nd low. We're looking for a March 26th or 8th low. Then it had a rally till April 1. We're looking for the same thing here. And then a decline until April 26th. Back then, which is very similar to what we're looking for here. Possibly it'll go into May, as late as May 6th, where the 20-year, 2-month cycle would come in. So this is what is likely to be the next 6 months. You know, we're looking at a storyline with the market's going to go a little bit down now, go a little higher in March, and then come down and up and finally go down into April. And then what? What happens the second half of the year? In this next chart, we show you what actually happens based upon several different cycles. The one that we're talking about, the 1934 market and the 1993 market, I showed this last time. They turn out to be almost identical going forward, and they both have a huge rally. How can a huge rally happen in this world? The markets are going to do what they're going to do, and the fundamentals are going to be what they are, and the fundamentals will eventually reflect in the market. But in this case, something's going to change. Some fundamentals may change. There's probably going to be a recession, but it'll happen and the market will go up anyway. So this is going to be an interesting time. Why? There's a statistic, you know, a very simple one, that the 4-year election cycle is very famous. And if you would buy at the midterm election, if you buy at the date of the midterm election and get out 2 years later at the actual presidential election, the next one, do you know that you, on average, over the last 50 years, in that 2-year window, you have made an average of 50% over the 2 years, 25% per year? That's an average. Of course, some years it's not as much. And it's fairly uniform. It's failed only once or twice since the Depression in the 1930s. And we're in that now. We're in that phase right now in the second half of the 4-year cycle pattern, which, based upon that statistic, would go up all the way until the end of 2024. It may not. That may not work. It didn't happen in 2008, collapsed earlier. But this momentum on the upside is likely to start this year and probably continue at least until the beginning of next year. Okay, and we'll comment further on the bigger picture. Okay. Now, the third cycle that we talked about, which is very real and very reliable, is the 37.5-year cycle, and that has been uniformly creating bear markets, interestingly enough, for the last 200 years. Okay, we looked at the 1984 market high and the 1946 market high and the 1910 market high and 1873 market high and the 1837 market high and 1799 market high. Each one of them was the beginning of a 4 or 5 year bear market. So how can we have a big rally in the middle of a bear market? Well, if you look closely, that did happen. In each case, there was some kind of a rally. You know, 1946, it went down. 47, 48, it went slightly up, or chop, and then it came down in 49. Okay. 1984, it went down. 1985 and 86 were up slightly, and even somewhat more in 1987. And then at the end of 1987, the whole 3 or 4 years of work was taken away in one day. So bear markets can have funny middles. They can have big B-wave middles, which are very significant. And so here's an example of how closely are they repeating right now. So we looked at the 88-year and the 29.5-year cycle. I show you the 20-year cycle, which is lining up even as we speak. It's almost exactly the same the last 6 months. We're in January of 2003, matching January of 2023. In that case, the market came down into March, and there was no secondary low in May. But there's a chance that the market, that 20-year thing, will turn into 20.16 years before it's over, and there will be another dip going into the May low. Again, after that, 2003, it went up, and it went up the whole year until January of 2004. 1963, 1982, 1983, you had the 82 low and a huge rally in 1982 and 1983. It took off and topped out in 84. Okay, that's 40 years, 20 times 2. 60 years, 20 times 3. You've seen the repetition of the 60-year cycle. I've been showing it for 3 years now. 1961 looks like 2021. 1962 is almost exactly like 2022. 1963 has been and continues to look really much like the present market, and it goes up. Okay, 1942, 80 years and 8 months. Turns out there was a low in April of 42, and the market worked its way higher, and it actually worked its way all the way up until 46. Okay, but it was up, at least for that first year, it was fairly bullish in 42 into 43. Now, the 1902 market actually lines up with 2023 because it's 20.16 times 6. It comes out 121 years, not 120. And 1902 was an up year. 03, of course, was bearish, and that would be the equivalent of 2024. So possibly 2024 will start to get nasty again, but based upon what we're looking at now, 2023 will have some bearishness, although not extreme, until March or May of this year, and then the second half of the year, particularly bullish. It's also possible there'll be a pullback in August, but again, on the way up and not a major deal, and then it goes up into October and again into December of 2023. Okay, another pattern we wanted to show, let's look at that 38-year cycle. It turns out it's a little bit stretched here. 1984 looks extremely much like our present market in 2022, and where we are right now in the late part of 1984 matches January of 2023. And that market went up. It went chop, chop, chop for a while, but it went up in 85 and had a high in July, but that would be 3 months off because we're a little bit more like 38.25 years now. That high would come in October this time. All right, and so those are examples of what's been happening and why we're looking at a very bullish year. And the short-term stuff, I think, right now is probably slightly bearish until February 3rd, and then it starts to go up and down into late April, at which point all bets are off. We're probably going to see a nice, strong rally. Another thing I mentioned last time, which is unfolding, it seems, is that if you look at last year and you look at the dates of last year, a good deal of those dates will reoccur this year, except upside down. We had a high last year, January 5th. We're going to have a low area January 5th. If you look at what happened, there was a decline till January 26th, and it's very possible that we'll have a little bounce even now into next week, starting on the 20th until the 26th. We may see continued upside. It may not take out the high of the 17th, but it may come close, in which case that would fulfill repeating last year upside down. And then there was a rally until February 3rd last year. We probably will have a decline till February 3rd this year. And then there was a decline till February 24th last year. And there's very likely we're going to see a rally till February 24th this year. It chopped around until mid-March, and then it fell hard into late March. And we're expecting a decline ultimately from February 24th to late March, followed by a rally into early April. We had another retest high in mid-April, and then the decline into June, and we will have a rally that will probably take us up into June or July. So, and then there was again, we had a low in June and be a high in June. Last year there was a high in August, there'll probably be a low in August this year. There was a low in October, next year probably a high. There was a low in December this year, probably next year a high. So it's kind of remarkable how this happens. And the reason is Mars has a 2-year cycle, and it tends to have kind of a year of courage and a year of fear. And I guess we could say this is the year of courage that's going to come around the bend here, despite all the fundamentals being miserable, despite the war in the Ukraine, despite inflation, despite all the things that seem to be miserable. There will be a way that the market will find its way higher, okay? I'm going to discuss some other markets next time, but this has been pretty lengthy and I didn't want to go on forever. So have a good week trading and enjoy the winter. Take care.